Welcome, Stock Explorers, to the Deep Dive. Today we're plunging into the fascinating and, well, let's be honest, quite contentious world of Verve Therapeutics, Inc., and specifically those buzzing rumors of a major acquisition by the pharmaceutical giant Eli Lilly.
It's definitely got people talking.
Absolutely. Our mission today is pretty clear. We're going to unpack Verve's pretty groundbreaking business. We'll dissect the details of this proposed acquisition, analyze what it really means for you as a potential investor, and pinpoint the key milestones we all need to watch going forward. Okay, let's get into it.
Yeah, and it's important to remember, this isn't just another run-of-the-mill biotech deal. What's happening here could be really significant, not just for Verve and Lilly, but for the whole field of genetic medicine and how Big Pharma is trying to grapple with these, well, truly disruptive technologies. The stakes are incredibly high.
High stakes indeed, for patients, for investors. So let's jump straight into the headlines that caused such a stir. Reports are flying around that Eli Lilly is in advanced talks to acquire Verve, and the total potential price tag could hit $1.3 billion.
Yeah, $1.3 billion.
On the surface, that sounds like a massive win, right? Yeah. A huge premium, over 130% compared to where Verve was trading just before the news broke.
It sounds great. But here's where that headline number starts to get a bit tricky.
Okay.
You see, Verve is sitting on a lot of cash, nearly $500 million, actually.
Right.
And that cash isn't excluded from the $1.3 billion headline price. So if you subtract that cash from the total deal value, what Lilly is really paying for Verve's technology, its IP, its pipeline, it's closer to $802.9 million.
Ah, okay. So the enterprise value is much lower.
Exactly. And that cash-adjusted number is precisely why you hear some investors, quite loudly actually, calling the potential deal awful or even peanuts.
Peanuts for nearly $1 billion.
Well, their argument is that this figure drastically undervalues a company with the potential to completely fundamentally change a multi-trillion-dollar cardiovascular market with a one-time cure. It highlights this huge gap between the paper value and what some believe is the real transformative potential here.
So drilling down on that, why is this distinction so crucial for you, our listeners, as potential investors?
It's all about understanding the real cost versus the perceived value. Don't just look at the big headline number. You need to dig into the details to grasp the true financial implications and understand why this deal is generating so much debate.
Okay, let's dig deeper then. Here's where it gets really interesting, I think. Let's break down that $1.3 billion total price. How is it structured?
Right, so about $1 billion of that is proposed as an upfront cash payment. If you divide that by Verve's roughly 89.14 million outstanding shares, it works out to about $11.22 per share. That's the guaranteed part, the cash you get right away if the deal closes.
Okay, $11.22 guaranteed. But the total was $1.3 billion. So where's the other $300 million?
That extra $300 million comes in the form of contingent value rights, or CVRs. These are tied to hitting specific future milestones, clinical trial success, regulatory approvals, maybe even commercial sales targets down the line.
CVRs.
If, and it's a significant if, all these milestones are achieved, the total payout could reach that $14.58 per share mark.
So CVRs basically bridge the gap between what the buyer wants to pay now and what the seller thinks the company could be worth later.
Exactly. It mitigates the risk for the buyer, Lilly in this case. They pay less up front. But it gives the seller's shareholders, Verve's shareholders, a chance to still benefit if the pipeline delivers on its promise.
What kind of milestones are we likely talking about for Verve-specific drugs, like VERV-102?
Good question. For VERVE-102, that's their main cholesterol drug targeting PCSK9, milestones could be things like successfully finishing the current Heart-2 Phase 1b trial, then initiating the planned Phase 2 study, which they're targeting for the second half of 2025, getting positive data from that Phase 2 trial. And then the big ones, submitting the BLA, that's the Biologics License Application, to the FDA, and getting it approved.
Okay, pretty standard clinical and regulatory hurdles. What about their other programs?
Similar idea. For VERVE-201, which targets AGPTL3, another cardiovascular target, it could be positive data from its Pulse-1 Phase 1b trial, also expected later in 2025, and then starting a Phase 2 trial for that one. And for VERVE-301, their earlier stage LPA program, maybe milestones linked to filing the IND, the investigational new drug application, or dosing the first patient in a Phase 1 trial.
But you mentioned it's a big if. CVRs aren't guaranteed money, are they?
Absolutely not. It's crucial to understand the risk. History is full of examples where CVRs ended up expiring worthless because the milestones weren't met. The Bristol-Myers Squibb acquisition of Celgene is probably the most famous recent example where a multi-billion-dollar CVR paid out zero. Really highlights the high-risk, uncertain nature of this part of the deal. It's future potential, not cash in hand.
And that uncertainty, combined with the upfront price, brings us back to that shareholder frustration, doesn't it? Because if you compare that absolute maximum potential deal value, the $14.58 per share, with where Wall Street analysts think the stock should be, people, the consensus price target is around $25.75 per share.
Wow, big difference.
Huge difference. And some individual analysts have targets as high as $39. The offer, even the maximum potential offer with CVRs, doesn't even reach the lowest analyst target out there, which is $15.
Right, so you can see quantitatively why shareholders are arguing it's undervalued. It's not just gut feeling. The analyst consensus is way higher.
Okay, so we've talked a lot about the deal itself. Let's shift focus. What about Verve as a standalone company? What's the core business here, and why is it considered so potentially valuable? You mentioned the blockbuster thesis.
Exactly. The core idea behind Verve is revolutionary, really. They're not aiming to treat symptoms or manage chronic diseases. They're aiming to provide potential one-time cures for very widespread medical conditions, starting with cardiovascular disease.
One-time cures. That sounds game-changing. What kind of markets are we talking about?
The potential reach, the total addressable market, or TAM, is just immense. Take heterozygous familial hypercholesterolemia, HeFH, that's a genetic high cholesterol condition. Affects maybe 3 million in the US and EU, 31 million globally.
Okay, big numbers already.
But then expand to the broader category of atherosclerotic cardiovascular disease, ASCVD, basically, heart disease caused by plaque buildup. We're talking hundreds of millions of people worldwide.
Hundreds of millions.
And then there's elevated lipoprotein A, or LPA. This is a specific genetic risk factor for heart disease. It's estimated to affect something like 1.4 billion people globally.
1.4 billion. That's almost hard to comprehend for a single target.
It really is. The scale is just on another level compared to most drug targets.
So the market potential is clearly there. What about the technology itself? What gives Verve its technological moat, as you put it?
It comes down to two key things, I think. First is their core gene editing technology, in vivo base editing. This is considered a next-generation approach. Think of it like using a pencil and eraser on the DNA code, making very precise, single-letter spelling changes.
A pencil and eraser, okay. How's that different from something like CRISPR-Cas9, which people might have heard more about?
CRISPR-Cas9 is more like molecular scissors. It cuts both strands of the DNA to make its edit. Base editing, crucially, makes the change without that double-strand break. By avoiding the cut, it's theoretically safer. Lower risk of off-target mutations or other unintended genomic rearrangements.
So, potentially more precise and safer. What's the second part of their moat?
That's their delivery system. Getting the gene editor to the right cells in the body is a huge challenge in this field. Verve uses proprietary lipid nanoparticles, LNPs. They had an early version using VERVE-101 that ran into some liver safety issues. That was a setback.
Right, I remember that causing some concern.
But the successor drug, VERVE-102, uses a different internally developed LNP system. They call it GalNAc LNP. And the initial data from the Heart-2 trial using this new LNP has shown a remarkably clean safety profile so far. Successfully de-risking that delivery vehicle is a massive step forward and adds enormous value. It was a key overhang for the company.
And this isn't just theoretical progress, right? They have actual clinical data.
Yes, absolutely. They announced positive initial data from that Heart-2 phase 1b trial for VERVE-102 back in April. In the highest dose group, they saw an average reduction in LDL cholesterol, the bad cholesterol, of 53%. One patient even saw a maximum reduction of 69%. And critically, this was achieved with a favorable safety profile.
And how does that 53-69% reduction compare to existing treatments?
It's right in the ballpark of current injectable drugs like PCSK9 inhibitors. But the huge difference is those require injections every few weeks or months, indefinitely. Verve's therapy holds the promise of achieving that same level of reduction potentially with just a single one-time treatment.
A one-time treatment versus lifelong injections. You can see the appeal. Has the FDA weighed in on this?
They have, which is also really important validation. The FDA cleared Verve's IND application for VERVE-102 back in March 2025, allowing them to start enrolling patients in the U.S. And then in April 2025, they granted it Fast Track designation.
Fast Track. What does that signify?
It means the FDA acknowledges that the therapy has the potential to address a significant unmet medical need for a serious condition. It allows for more frequent meetings with the FDA and opens the door for potentially faster review processes down the line. It's a strong signal from the regulators.
Okay, so Verve has the huge market potential, the cutting-edge tech, the positive early data, and some FDA validation. Now let's connect this back to Eli Lilly. Why are they so interested?
Well, Lilly's pursuit makes a lot of sense strategically, I think. It's playing both offense and defense.
Offense and defense, how so?
Offensively, it's a move to secure a leading position in gene editing, which many see as the future of medicine. Get in early on a potentially dominant platform. Defensively, it's about neutralizing a potential existential threat. Think about it. A one-time cure for high cholesterol or related cardiovascular issues could eventually decimate the sales of Lilly's own blockbuster chronic care drugs.
Like Mounjaro and Zepbound, the weight loss and diabetes drugs.
Exactly. Those rely on repeat prescriptions, generating billions year after year. A one-time cure model completely upends that business. So acquiring Verve could be seen as a way to control that disruptive technology, integrate it, or at least prevent a competitor from getting it.
It sounds like a major strategic shift for Lilly, moving so aggressively into this high-risk, high-reward gene editing space.
It definitely signals a paradigm shift. They're using the enormous cash flow from their current blockbusters to place big bets on the future. Acquiring early-stage assets like Verve is about anticipating where medicine is going, not just reacting to current trends.
Now, whenever a company like Verve is in play, it raises an important question. The possibility of a bidding war. Is that realistic here? Are there other logical buyers who might step in and challenge Lilly's offer?
I think it's definitely a distinct possibility. Once the target is known to be considering a sale, it often flushes out other interested parties. And yes, there are several logical suitors you could imagine making a counteroffer.
Who comes to mind?
Well, Novartis jumps out. They're a global powerhouse in cardiovascular medicine already, and they have significant investments in gene and cell therapy. Verve fits perfectly in their wheelhouse.
Makes sense. Anyone else?
Sanofi is another one. They've been actively reshaping their portfolio and have shown they're willing to pay premiums for strategic assets they really want. And you can never count out Pfizer. They have massive cash reserves, a long history of large M&A deals, and a stated interest in building their gene therapy capabilities.
So Novartis, Sanofi, Pfizer, any of those could potentially see Verve as a strategic prize worth fighting for, maybe pushing the price higher than Lilly's current rumored offer.
Potentially, yes. Which leads to the dilemma facing Verve's board right now. It's the classic bird in the hand problem.
Right. Take the sure thing now or hold out for potentially more later.
Exactly. They have this $1.3 billion offer, mostly cash up front, on the table. That provides certainty, a de-risked exit for all shareholders immediately. The alternative is to go it alone, stay independent, try to develop these drugs themselves. The potential upside is enormous, perhaps many multiples of the current offer if they succeed. But the path is incredibly long, incredibly expensive, and fraught with risk. Biotech development is notoriously difficult and capital intensive.
And you have influential shareholders to consider too, right?
Absolutely. You have major institutional investors like Alphabet's venture arm, GV, and big asset managers like BlackRock. Depending on their own fund structures, timelines, and risk tolerance, they might actually prefer the certainty of a cash exit now, even at a price others deem too low. That can put pressure on the board to accept the deal.
Okay, so there's deal risk, strategic rationale, potential bidding wars. Let's talk about the fundamental risks associated with the technology itself. What keeps people up at night when thinking about in vivo-based editing?
The single biggest question mark, the elephant in the room, is long-term safety and durability. We are talking about making permanent changes to a person's DNA inside their body. That's a profound intervention.
Permanent changes.
Right. And while the preclinical and early clinical data looks promising, the truly long-term consequences are still unknown. Years, decades down the line. Concerns revolve around things like off-target editing. Are changes being made elsewhere in the genome unintentionally? Immunogenicity. Will the patient's immune system react against the LNP delivery vehicle or the editing machinery over time? And the most serious theoretical risk, oncogenesis. Could these permanent DNA changes somehow increase the risk of cancer developing later in life?
Those are serious potential long-term concerns. What about more immediate risks related to the deal itself?
Well, there's the very real market risk that the acquisition talks could simply fall apart. Deals collapse all the time. If that happens, the premium that's currently baked into Verve's stock price because of the M&A speculation would likely evaporate overnight. The stock could easily fall sharply, potentially going back below where it was before the rumor started, maybe even lower, as the market refocuses on the standalone risks and the long development timeline.
You also have the practical challenges, right? Even if the science works perfectly.
Huge challenges. Manufacturing these complex gene therapies at scale, ensuring quality control, managing the logistics for global distribution. These are immense hurdles that need to be overcome, even after clinical success.
And one more market dynamic to throw in here. The short interest. Verve has a lot of people betting against the stock, doesn't it?
It does. Reports suggest over 30% of the public float is sold short. That's unusually high and indicates significant bearish sentiment from a portion of the market. They're betting against the company's success, or maybe against the deal happening at this price.
But that high short interest also creates the potential for a short squeeze, right?
Exactly. If the deal is finalized, especially at a premium, all those short sellers have to buy back shares to cover their positions, often quickly. That forced buying, combined with regular buyers anticipating the deal closing, can create intense upward pressure and drive the stock price rapidly towards the offer price. It adds another layer of volatility.
Okay, so let's try to summarize this complex picture. We have the core dilemma for Verve and the investment thesis.
Right. On one hand, the opportunity is just monumental, truly transformative potential. The chance to fundamentally change how we treat cardiovascular disease, shifting from chronic management to a one-time cure. That unlocks a market of almost unprecedented scale, generational value creation, potentially.
The ultimate upside.
But on the other hand, the greatest risk is the fundamental uncertainty around the long-term safety of permanently altering human DNA in vivo. While base editing is designed to be safer than older methods, we just don't know the very long-term effects. Any significant unforeseen adverse event years down the road could be catastrophic, not just for Verve, but for the entire field.
So bringing it all back to our listeners, what does this mean for you if you're considering Verve stock right now?
Well, I think it's fair to say the investment case for Verve at this moment is largely dominated by M&A speculation. If you're taking a long position now, you're essentially betting on one of two outcomes. Either this current deal with Lilly gets finalized, potentially leading to that short squeeze up to the offer price, or a higher bid emerges from one of those other potential suitors we discussed, Novartis, Sanofi, Pfizer, someone else sparking a bidding war and pushing the price higher. It's become a very event-driven situation, high risk, high reward, based on deal outcomes, more so than just the underlying science in the short term. Any investment decision needs to be made with a clear understanding of that dynamic.
Wow, what an incredible journey we've taken today, really diving deep into Verve Therapeutics, the Eli Lilly offer, and all these complex layers of value, risk, and potential futures.
It's definitely a fascinating situation to watch unfold.
Absolutely. And as we wrap up, here's a final provocative thought for you to consider. How will this potential acquisition, whether it's Lilly's deal or a competitive bidding war, ultimately redefine the future of genetic medicine? And how might it reshape the strategic direction, the very identity of Big Pharma for decades to come? The ripple effects could be enormous.
A lot to think about there.
Indeed. If you, our Stock Explorers audience, found this deep dive valuable, please remember to hit that subscribe button, give us a like if you enjoyed it, and definitely activate those notifications so you don't miss our next exploration. Thank you so much for joining us today.
Thanks, everyone.
We'll see you on the next deep dive.